Hello, everyone, and welcome to another Lunch and Learn webinar. I'm your host, Mayur Thaker. I'm the Senior Relationship Manager here at Zacks, and I work very closely with all of our ZRS clients. And if you're not familiar, the Zacks Research System is the flagship institutional level equity research platform that we develop. And this system is what we're going to be using today to do a little bit of a deep dive into balance sheet analysis. And I say deep dive, but really, what our goal here for today is is twofold. One is obviously to highlight the importance of looking at a balance sheet when making investment decisions, but also how easy it is to do it within ZRS. So we're going to be focusing on those two things here today. So as a background, with the entire COVID shutdown and the entire economic crisis that entailed after that, we've seen an incredible dispersion of companies across the market, and many of them are doing extremely well. And those are the companies within, particularly within technology, and other companies are not doing so well. So, what can we learn from looking at balance sheets to be able to avoid some of the major pitfalls that have occurred due to the economic disruption that we've seen from the shutdown in COVID, as well as changes in consumer behavior as a result of the pandemic. So we're going to take a look at, different examples of companies that have strong balance sheets and companies that have very poor balance sheets. And we'll use tools within ZRS to help understand and highlight that. So what are some of the ratios that we're going to look at? There's going to be four primary ratios that we take a look at here that I think are particularly useful, as well as very easy and very simple to view. The first one is just the very simplest, which is looking at cash, the cash that's reported on the assets section of the balance sheet, and look at it relative to the short-term debt that the company has. And by short-term debt, we mean, the debt that is coming due within 1 year. And that's going to be reported on the liabilities section of the balance sheet under current liabilities. So we're basically looking at companies with regards to how much cash they have versus how much debt that's actually coming due in the very near term. And during economic crises, this becomes very, very important because, as a recession unfolds, it becomes a big question as to whether the company is able to service its very short-term debt that's coming due. And if it becomes a question whether the company can, actually service that debt, then shares come under extraordinary amount of pressure. So we're going to take a look at that. And by the way, if you have any questions, please do type that into the question section of the GoToMeeting webinar panel, and I hope to be able to to review that. And so the first ratio, as we just mentioned, is cash versus short-term debt. The second ratio is the quick ratio. And the quick ratio just looks at a ratio of just cash and accounts receivable versus current liabilities, total current liabilities. So it's a very small change from the first one, but we'll look at the cash ratio as well. And then we're going to look at the net debt to EBITDA. And this is a favorite metric for most, or if not all, credit rating agencies. They look at this ratio pretty closely when assigning their credit rating. And so we're going to look at this ratio as well as a way to be able to understand what the big picture is with regards to the company's balance sheet leverage relative to how much income they produce. So that's the EBITDA number. And then lastly is the liquidity ratio. And this is a custom ratio that I just put together. which, and we're going to define that in a few slides here, but basically it looks at the company's cash plus their free cash flow minus dividends divided by total current liabilities. And so I'm going to walk you through each one of these, the latter three here. The first one is pretty self-explanatory, so we're going to take a look at just what each of these mean. So the quick ratio, as I mentioned, is just cash and equivalents plus the receivables that they have divided by current liabilities. So it measures the ability of the company to meet its short-term, meaning less than 1 year, financial obligations, which also includes any principal payments on debt and any amounts owed to suppliers or other lenders. So this is a very, very important, especially when there is an economic disruption like what we experienced this year. Suddenly the quick ratio becomes very, very interesting to look at for different companies. The next one is net debt to EBITDA. So this is just basically total debt, which basically includes short-term debt plus capital leases plus long-term debt minus cash. So that tells you that numerator gives you the net debt, and then the denominator is the EBITDA number, which is a measure of how much income the company produces before interest, taxes, and depreciation. So this is the ultimate measure of how much leverage your balance sheet has relative to the level of income that the business produces. And very highly rated companies by the credit rating agencies like Moody's and S&P, they typically have a ratio that's no more than 2 times. There's obviously many exceptions to that. It can get up to 6 or 7 times, even for investment grade rated companies, but the average is around 2 times, 2x. And then lastly is the liquidity ratio that I mentioned. And this is a custom metric that looks at cash plus free cash flow minus dividends, okay, divided by current liabilities. So dividends are usually not a concern when it comes to valuation or when it comes to, leverage. But as we're going to see, there have been many companies that have gotten into deep trouble this year because of living off of a policy of paying and growing dividends paid for by cheap and very available debt. And that's what's been the story of the 2010s with the Fed, cutting interest rates extremely low and making credit very available for very, very cheap. There's been many cases of very large companies that have paid more in dividends than their total free cash flow. And we're going to see an example of that, a couple of examples of that. And this includes not small companies and not even medium-sized companies and not even large cap companies. I'm talking about companies that are within the Dow Jones that have done this. And specifically, we're going to talk about Exxon, where Exxon has paid more in dividends for many years than the total amount of free cash flow that they generate. So what that's done is it's actually depleted their cash balance and therefore depleted their liquidity ratio and their quick ratio and all the other leverage ratios that we just mentioned here. So this measures how well a company can cover its total short-term financial obligations after considering its current cash position, cash income, and cash outflow, which are dividends. And this ratio has done exceptionally well at predicting returns over the past 15 years to help, avoid companies that are vulnerable to an economic downturn. So let's take a look at that. I used, within ZRS, we have a couple of different back testing modules. And so within the back tester, I used a back testing option called the rank analysis that lets you test different factors. And I went ahead and tested that last factor that I created called the liquidity ratio. And here are the results of that. So since 2004, I went back to the full amount of history that we had available. So a full 16 years of history. And you can see the cumulative value of $1 over time invested into these different buckets based on the liquidity ratio. And you can see here that not only does this green line have the best returns, but you can see a clear separation starting in 2012, or really in the post-Great Financial Crisis era, where there's a separation between the top pack and the bottom pack. And the bottom pack are, as you would have guessed, the companies that are in bucket number 1 and number 2. So those are the two buckets that are lowest in terms of the liquidity ratio. So I created 6 buckets here. I just decided to go with 6. You could do 5 or you could do 10, as many as you'd like, but I just went with 6 here. And you can see clearly that a bucket number 1 and bucket number 2, which are the companies that have the lowest liquidity ratios, have underperformed the other 4 buckets. And you can see here that bucket number 6, which are the companies that have the highest liquidity ratios, have fared the best. So this is very, very revealing to tell you that the liquidity ratio, ignoring all other factors, we're not even talking about the company's business or how much growth it has, we're not talking about valuation ratios, anything like that. We're just looking at the company's liquidity, meaning their cash plus free cash flow minus dividends divided by total current liabilities. And so the companies that have the best ratio according to that calculation have historically done the best. And really the big tell here is not necessarily that the highest bucket has done the best, but that there's a clear separation between companies that have average to above average in that liquidity ratio versus companies that have very below average liquidity. And you can see here that these are the average returns over time. You can see the standard deviations of returns, and then really the delta ratio, which looks at return per unit of risk. And you can see that bucket number 6 and number 5 have the best risk-adjusted returns. And buckets 3 and 4 actually are pretty good as well. And then you'll see a pretty big drop off with bucket number 1 and number 2. So clearly you want to pay attention to this ratio, this liquidity ratio, which again, going back to it, is this factor right here: cash and equivalents plus free cash flow minus dividends divided by current liabilities. Okay. And so you can actually I created an Excel sheet that actually calculates this out over different quarters of time. And I have this actually pre-built here. So if you want access to this, I'd be more than happy to send you the spreadsheet, and you can look at it for any companies that you are interested in. And basically it's linked to our Excel add-in tool, which lets you just click a button right here, refresh all, and it will then update this table for whatever companies you have entered into this. So I just have a couple of examples right here that we're going to just review today. The first two are Exxon versus Chevron. So I'm trying to make this as apples to apples as possible, where you can see the efficacy of this for very like-to-like companies. And Exxon and Chevron, you can make a pretty strong case to say that these two companies are facing the same exact challenges. They're both highly exposed to the commodity price of WTI crude oil. So you can say that these two companies have the same set of challenges right now. But you can see there's a very wide distinction between the liquidity ratio of Chevron versus Exxon. You can see that Chevron has a liquidity ratio of 0.37, whereas Exxon is negative, right? And that goes back to the point that I was making, that this number is negative because their dividends have actually outpaced their total free cash flow for several years now. And so that's how this number can be negative. So, you can see that if I go into ZRS, and I created a little pitch book right here called balance sheet, and you can build one like this as well. let's just take a look at the performance year to date of, Exxon versus Chevron. And I'm just going to change this to a year to date number. And you can see that despite the fact that these two companies have the same set of challenges, you can see Chevron, has, obviously done very, very poorly year to date, right? It's not like this is a winner by any means, but you can see that there's a clear separation of returns of Exxon versus Chevron. And why is that, right? We just saw that their liquidity ratio is much better. But let's just look at their balance sheet and let's look at the very simplest number, which is that first ratio that I mentioned, which is just looking at cash relative to short-term debt. And see over here, I have our balance sheet, and this is an industrial template. So this helps condense a lot of different complex items into a very easy to read format. And this is available right within our financials tab under summary standardized and balance sheet. And you can see here that if you go back to Q4, right? So like if we were to back out to the very beginning of the pre-COVID, or right before COVID started, you can see that Exxon had a cash balance of about $3 billion. And look at their current debt. That is insane. They had current debt, meaning debt that's due within 1 year, of $20 billion. $3 billion in cash on hand, 20 billion in current debt that's coming due. That is incredible. Now, if you look at Chevron, switch that a little bit here. That's, a ratio of more than 6 times, 20 billion versus 3 billion. But if we look at Chevron, that number is quite different. And once we see that here, we'll kind of get an idea of what that looks like. So with Chevron, as of Q4 of last year, 5.7 billion in cash, 3.2 billion in current debt. So if I were someone that wanted to be investing in the oil patch, which I'm not, but if you had to gain exposure to oil for whatever reason, if you really wanted, exposure to energy, and we were not in this, in this COVID crisis, I would be, very, very wary to recommend a client buy shares of Exxon over and above Chevron. So with Chevron, you see a completely different picture. 5.7 billion in cash on hand, 3.2 billion in debt that's due in the short term, versus a completely different picture with X, going back to that, 3 billion in cash, 20 billion in debt that's coming due. That is just a ticking time bomb that can only be sustained if and only if Exxon can continue to roll over that debt. Essentially saying that they can continue to defer those short-term debt that's coming due and roll it over into long-term debt, basically refinancing that debt. That's usually not a good investment strategy. If the company is reliant on constantly rolling over debt and not being able to actually pay that debt out of their cash balance, then that's really not a good sign. So let's look at another aspect of this, which I mentioned earlier, which is dividends versus free cash flow. And this is where it gets really dicey. For a company like Exxon, if you see this here, this is a custom chart that I built, but you can see the blue line represents the dividend payments of Exxon, which looks really good. It's a very consistent stair-step growth in their dividend. But look at their free cash flow. And for many, many years, or really, for, a couple of years, 2.5 years between 2015 and 2017, a little bit of a reprise, in 2017 and 2018. But look at this, even before COVID hit, essentially all of 2019, almost, more than half of 2019, their free cash flow was below their dividend payments. So what this means is anytime free cash flow is less than their dividend payment, that necessarily means that that dividend payment has to be financed with debt. That's the only other way that you can actually do this. There is no way that you can possibly sustain the dividend without, borrowing money to cover that. So again, that is not a good look at all for the company. So now let's shift to Chevron. Let's look at Chevron. And again, these are companies that, are facing the same challenges, macro as well, the same macro challenges. And you can see here that Chevron was also an offender in this area as well for many years, but at least they did turn it around heading into the COVID crisis. So again, if I were someone that absolutely had to recommend a client investing their assets into energy, and you really wanted to own one of the major oil integrated companies, again, Chevron looks like it's a much better pick than Exxon. So what did all of this do to liquidity, right? So we can go over here to the cash ratio and just look at these two companies side by side, Exxon versus Exxon. And you can see here that there's, again, a clear distinction between the two. If I were to just put a 10-year chart of this, you can see that Exxon has really depleted their balance sheet, heading into the COVID, recession. And you can see that the cash ratio was basically at a 10-year low, basically down to 5%, 5% versus Chevron at 22%. So again, Chevron was in a much better financial picture from a balance sheet point of view heading into this, crisis. And again, this cash ratio is just basically cash divided by total current liabilities. So the combination of all of these factors is, in my view, the reason why Chevron has fared a little bit better than Exxon with, this entire disruption that has been caused by COVID. So the same idea you can apply to different companies as well. For example, another big topic of interest, especially in the financial media right now, are the airlines. So let's see what the airlines have been doing. And with the liquidity ratio, let's look at two major airlines, American Airlines versus Southwest Airlines. So right before the crisis hit, again, going back to Q4 of 2019, look at the difference between American and Southwest. American Airlines, with regards to their liquidity ratio, again, cash plus free cash flow minus dividends divided by current liabilities, was at 0.9, 0.19, so 19%. Whereas Southwest was much better at 0.79 or 79%. So this means that 79% of their total short-term financial obligations was available in cash and free cash flow after dividends. Okay, so again, let's look at who has done better. Has it been Southwest or has it been America? And you can see here that over the long term, obviously Southwest has been a big winner. But let's just look at the short term here, year to date, and look at that difference here. That is a pretty stark difference. American is down 55% year to date. And Southwest is not doing great, but it's at least doing much better than American. So again, if I were someone, if I were a fiduciary recommending clients, invest in airlines at this point going forward, or even before the COVID crisis, again, I would be looking at the balance sheet and just making sure that these companies have not depleted their cash balance or their liquidity. We can see that here again, if I were to go back to the balance sheet and looking at Southwest and seeing exactly how that looked like just before COVID hit from a cash and short-term debt standpoint. And you will be able to see that there as well, that, Southwest was in a much better financial picture. If you look at that right here in Q4 of 2019, 4 billion in cash on hand and 819 million in current debt. So that's pretty good. Switching to American, You can see the difference there. And I apologize that my Wi-Fi is a little bit laggy here, so there's a little bit of a delay. But hopefully that comes up here pretty quickly. And you can see that here now. So the difference here is that, American had 3.9 billion in debt and 2.8 billion in current debt. Sorry, 3.9 billion in cash, 2.8 billion in current debt. So that's not as bad as what we just saw for Exxon, but still it's much worse compared to Southwest. So, again, if I were to look at these different companies and have to pick between the two, I would make sure that I'm looking at these different factors that involve the balance sheet. So the other factor too is the leverage ratio, the overall leverage ratio. So if I were to look at West versus American, you can see that there's actually a pretty big difference there as well. Let's go back 10 years so we can see this a little bit more clearly. You can see that Southwest had a much better net debt to EBITDA ratio versus American Airlines. It was much lower. So the lower this is, the better. However, too low means that this EBITDA number could be negative. So that's not good as well. But you can see that, just before, COVID hit, you can see that Southwest had a net debt to EBITDA of 0.07, which is very, very low. And American had a net debt to EBITDA of 4 times. So that's pretty high. So again, overall, if you were looking at, the balance sheet relative to income, I would be very, very careful as to be looking at these specific ratios to make the decision as to which company to pick. The other item too to look at is that dividend versus free cash flow number. And you can see here for Southwest, dividends have, steadily grown over the past 10 years, which is really good to see. However, Exxon also had that steady dividend growth, but the difference is that Exxon's free cash flow was lower than their dividend payment. Whereas in this case, Southwest has a very comfortable dividend coverage ratio where their free cash flow is significantly better than their dividend payment. So this dividend is sustainable. However, you can see that, as a result of COVID and the unpredictability of when, passenger travel will ever bounce back, out of an abundance of precaution, Southwest, you can see they cut their dividend to 0. And this number, if you look at, American, look at the difference there. Their free cash flow versus dividends is nowhere close to the level of coverage that, that Southwest had. So these are very critical charts that I would look at. So you can see that there are way too many check boxes in favor of Southwest and against American. So, if I were someone that was looking at these two airlines to be able to pick which one would be in a better financial position, then you can see that, according to basically all of these metrics, Southwest has been the better pick. And as a result of that, you can see the benefit of that, where Southwest shares have, significantly outperformed American Airlines, not just over a 10-year period, but even, in the current environment where everybody is suffering. Both of these airlines are facing the same set of challenges with a precipitous drop in, passenger travel worldwide. But, you can see that Southwest is handling it much, much better than American Airlines. So the same analysis you can kind of do for all of these other companies that I had mentioned here. You can look at the same set of metrics for Marriott versus Hilton, as well as Walgreens versus CVS. Again, these are both companies that are facing the same set of challenges, but one has done much, and I would attribute much of that to the difference in their liquidity and their cash position relative to the liabilities that they have. So you can see here that Hilton has done much better than Marriott, despite the fact that Marriott is a global brand, probably the best global brand in the world when it comes to hoteliers. But Hilton shares have done much better during this crisis versus Marriott. And you can use the same exact sort of workflow to really understand why that's been the case. So again, go back to the balance sheet and look at cash relative to short-term debt. You can see that cash for Marriott as of Q4, right before the COVID crisis, 225 million in cash versus current debt of 977 million. So that is a little bit concerning. Again, that's cash that's less than the amount of debt that's coming due within 1 year. So again, this can only work again during normal times where the company has ample access to liquidity and they can continue to roll over that debt. So again, this is playing it a little bit aggressive, where the company is assuming that access to debt markets is ample and readily available at very cheap rates. Versus Hilton, let's look at Hilton. You can see Hilton had 630 million in cash on hand versus only 37 million in debt. Look at that. Big difference in cash versus short-term debt. So again, Hilton was much better prepared for any major economic downturn, and always has been. You can see their current debt is very low relative to cash. That's just how they manage their business. So again, balance sheets come into focus, especially when things like these types of economic disruptions happen. And so that's why Hilton has done much better overall versus again these different ratios. Hilton has a much better cash ratio relative to Marriott, 22% versus 3%, which is very low overall. And even according to the net debt to EBITDA ratio, again, you can see that Hilton has lower leverage versus Marriott. You can see that it was actually much higher a few years back, but they've really toned that down at pretty much the best possible time that they could have done right before the sort of the disruption of COVID. So again, these ratios are really important to watch. And I would create an entire pitch book that kind of deals with that. In this particular example, Marriott has actually done pretty well with their dividend coverage, so that's a little bit less concerning compared to the other examples that we saw with Exxon and with American Airlines. So these are not as bad for either company, but you can see clearly that one has a much better balance sheet than the other. And that's why Hilton shares have done, have fared much better than Marriott, year to date. So again, so these are all reasons why I would create a pitch book called balance sheet or balance sheet analysis or whatever you'd like to call it, and have these slides here ready to go. And it's very easy, very simple to be able to just tab through these different sheets here. And I would just make sure very quickly, very easily, that cash relative to short-term debt is not something egregious. Sometimes it's not that bad. You don't want to always position your investments such that they run it extremely conservatively either. But you just want to make sure that the company is not entirely reliant on debt to be able to fund their operations. The way Exxon. Again, if you go back to Exxon, you can see that 3 billion in cash, 20 billion in current debt. That's just so bad that I would be very cautionary as to proceed with that, especially since you have a that is also really, that's essentially the same in terms of their exposure to the energy patch, and their leadership within that sector that has a balance sheet that's much, much cleaner and much, much, is more sustainable than Exxon. So that is something that you can just eyeball very quickly and see. Or the best yet is to just use this liquidity ratio table to just quickly compare different companies within the same sector and see exactly the difference between the two. You can see very easily that Chevron, even now, has a much better liquidity picture compared to Exxon. And that difference was even greater right before COVID hit. So again, this is the ratio that I would personally pay attention to very, very closely to pick the difference between the two. And you can see even with this right here, Walgreens versus CVS, and we're kind of running over our time limit here, but I just wanted to quickly mention that as well. You can see right before, exiting 2019, the liquidity ratio for CVS was, 30% versus 13% for Walgreens. And look at the difference in performance of, versus those two. So if I go back to performance and type in, Walgreens versus CVS, again, these are companies that essentially are facing the same exact challenges. They're both retail and pharmacy exposure. They're both pharmacy benefit managers. So you can see that, despite the fact that they have a very, very similar business and a very similar set of challenges right now facing COVID, you can see that CVS has done much better than Walgreens, significantly better than Walgreens. And why is that? Well, one of the reasons is, and one of the major reasons I would say is that CVS has had a much better liquidity position versus Walgreens. Not to say that Walgreens is in any kind of serious trouble, but their liquidity was much worse versus CVS heading into the crisis. And even right now, as of Q2 2020, you can see that CVS's liquidity is at 45% versus 15% for Walgreens. So hopefully this has been helpful. If you would like this table, I can send this over to you. It's very easy to just download and run for any company that's in your watch list or in your portfolio and pit it against other companies within the sector. This would be a great way to basically make sure that you're picking the right companies within each sector. That is one great way that I would use this. But going back to this back test that I showed here, this is the big reason why this liquidity ratio is something of exceptional interest, because you can see that not only is it a performance driver, but it also helps you avoid the major pitfalls and separate companies that are a performance drag within your portfolio. So these bottom two right here are the companies that have the lowest tiers of the liquidity ratio, and that is clearly separated from the ones that are at the very least average to above average. So hopefully this has been helpful to you. Again, if you want this table, I'd be happy to send this over to you. Or if you want this back test result, I can send this over to you as well. Or if you want any assistance in building this pitch book, again, I'd be more than happy to do that for you. All of these are standard views that are available within CRS, with the exception of this view right here, the dividend versus free cash flow number. So if you want to see this, again, if I go back to airlines, you can see that that was a really bad picture versus Southwest. So this is a chart that I created within the interactive chart. So if you'd like some assistance on building that, I'd be happy to walk you through that. So if there are any questions, please post them in the GoToMeeting webinar right now. There was a question that says that is there an economic landscape that benefits leveraging debt over holding large cash balance? Yeah, that's a great question. So, of course, there's always a time and place for leverage. There's always a time and place for debt. I don't mean to imply that debt is bad per se. Debt, it can be a very, very powerful instrument to enhance um, returns to shareholders. But there's one metric that I would look at that helps you understand whether that leverage is actually accruing to shareholders or if it's just going to pay their current operations as well as pay things like the dividend. And that is the return on capital. So return on capital, I didn't mention this in the call today, but this is a big, metric that I would look at when also assessing whether a company's debt is creating value for shareholders or not. And this number is basically net income divided by their total debt plus total equity. So if a company raises debt, then that would actually hinder the return on capital because the denominator is increasing. But if in doing that, if it increases net income by a proportionate or greater amount, then that number would be going up. So in this case, you can see here that, Southwest, for example, had been increasing their return on capital in 2018 and 2019, right before the crash happened. So obviously, in the post-COVID era, nothing looks good. But in normal times, if a company is increasing debt, then I would like to see a fundamental shift in this return on capital. Meaning, if this number is going up, that means that debt is actually accruing to shareholders and creating value. But if that number is flat or going down, then it means that debt is being used for other purposes and it's not being done to actually create value for shareholders. So, going back to, say, for example, Exxon, you can see Exxon had a very poor return on capital. And you can see that, there's, that difference there you can see. But essentially what I was trying to say is the, Exxon had a dividend that exceeded free cash flow. And what that basically is telling you is that, this company is essentially taking on debt to be able to pay its dividend. So if you were buying Exxon for their dividend, then you are essentially saying that we want Exxon to borrow money to pay us that dividend, which is usually and almost always never a good idea. So to answer your question, there's always a good case for using debt, but I would want to make sure that the return on capital, which adjusts for that leverage, is going up when a company is borrowing money. If it's not, then there's other questions as to what that debt is being used for. If it's being used to pay the dividend, that's not a good thing. If it's used to pay just ongoing operations, that's also not a good thing, because that means that the company is not generating enough cash to cover its own expenses. So great question. Is there another question? Is ZRS completely web-based, or is there also a desktop app? ZRS is actually a desktop app. It's not web-based. There is a web-based platform, which we call the Zacks Advisor Tools. However, it does not have a few of these items, but actually, to come to think of it, the Advisor Tools application does have all of these items that we just covered here today. It just doesn't have the backtesting module the way that I just generated to show the study right here, but it does have all of these charts that are available to view, as well as the ability to maintain this Excel sheet right here. So if you're interested in either one, again, please reach out to us. Our email address right here, as I mentioned, zrs@zacks.com. Again, zrs@zacks.com. So if you're interested in either this software application, which has a few additional tools like valuation modeling, composites, and other things that we didn't cover here today. But out of all the charts that we viewed here today, those are also available in the web-based application, the web-based platform called the Zacks Advisor Tools. Another question we have is, instead of having a company and doing research, is there a way to look for certain companies that meet certain criteria, i.e. the liquidity ratio? Great question, yes. We can absolutely create this in our screening tool to basically find companies that match that criteria. So again, I have actually created this from before here. So you could use the screening tool to help you find companies that have an attractive liquidity ratio. So I had actually created this, and this is a little bit out of the scope of our webinar here today. So I won't spend too much time on this, but we can take this offline to walk through this as well. But this screening tool helps you find companies that match any criteria that you'd like to see. And in this case, I already had created a report that shows all 500 companies of the S&P 500 and sorted by sector membership and the liquidity ratio. So you can see within, for example, apparel, who has the best liquidity and who has the worst liquidity. Or within food companies, organized by that. Within, other, industries, you can see that here. Or if you wanted to go a little bit broader, you can do it by sector rather than by industry group. And now you can see within, consumer staples, Monster Beverage actually had the best liquidity ratio, and this company Cody had actually the worst one. Archer Daniels had the second worst. So you can see the spectrum, the sort of the dichotomy of different companies by sector by their liquidity ratio. So again, if you want to build this, I'd be happy to take this offline and we can work on that. Another question is compare only one-to-one, or can you group? Can a group be compared? Yes, you can absolutely compare a group. So if you wanted to see, for example, the balance sheet of the energy, sector overall, that's absolutely, capable of being done. So if I were to type in, we have a special ticker for this called SP5EM. That refers to S&P 500 energy market cap weighted. And if I were to enter that into this balance sheet here, then this is going to give us the weighted average balance sheet of the entire energy sector. And you can do this for any of the other charts too, like the net debt to EBITDA, or you can even do this for all companies within energy to look at the liquidity ratio. But you can see here, for example, that the market cap weighted average energy stock had about 2.7 billion in cash and 4.8 billion in current debt. So energy overall was in trouble to begin with, because, again, cash, was less than short-term debt coming due by almost a 50% margin. So again, energy overall not very well positioned to be able to weather an economic crisis. But you can see that, Exxon was much worse than even the average energy stock. You can see that, if you recall, Exxon was at 3 billion cash, 20 billion current debt. So that margin was ridiculous, much worse than the average of the sector. And so you can do the same thing for any of these other metrics here: cash ratio, net debt to EBITDA, pretty much any of these metrics that you want to see. Okay. So is there a replay? Yes, there will be a replay. We will upload this to our YouTube channel, so we will send that out. So that's about all of the questions I think we had. Will the slides be available? Here's another question. Yeah. Will the slides be available? Will return on capital be added as a factor? Yes, you can add this as a factor into your ZRS pitch book, or you can add it into the spreadsheet as well. I'll go ahead and add it into the spreadsheet so you can have that as well. So if you'd like to request any of these materials, again, please reach out to us at zrs@zacks.com and be happy to send out any of these materials here. So I try to keep this at half an hour, but we're way beyond that. So please forgive me for that. But hopefully you found this beneficial to incorporate into your investment process. And if you'd like to discuss any further, I'd be more than happy to do that with you one-on-one or by email. So please do reach out to us at zrs@zacks.com with any questions or any feedback, or if there's any topic you'd like to cover in a future webinar like this, please do suggest that, and I'd be happy to do that next time. Alrighty, thanks everyone, and hope to hear from you soon. And hope everyone is staying safe and wear masks, and please try to socially distance as much as possible, and have a good one. All right, take care. Bye-bye.